Hello, everyone. Welcome to another episode of Do Academy. Starting out in trading can be a challenging experience, especially when faced with difficult questions such as when to buy, sell, or hold an asset. Fortunately, there is a technique that can help, namely understanding stock chart patterns. By understanding these patterns, traders are able to gain valuable insights to an asset's behavior and make informed decisions. In this episode, we'll take a deep dive into stock chart patterns and demonstrate the technique that will help you to stay in control of your trades. When traders first look at the price chart of an asset, it can appear as if the price movements are completely random. But, hidden within these movements are patterns that can be identified and used to make informed trading decisions. A common pattern type that traders often look out for in price charts are geometric shapes. Continuation and reversal patterns are the two most common types of geometric patterns that traders use to make predictions about where the price may be headed. A continuation pattern suggests that the price trend will likely continue in its current direction after a period of consolidation or correction. It's like a pause in the trend before it continues to move in the same direction. Examples of such continuation patterns include bullish or bearish flags, pennants, rectangles, and triangles. Reversal patterns suggest that the price trend is likely to reverse its current direction. These patterns usually occur when the bulls or bears have exhausted their momentum, and new energy emerges from the other side, causing the trend to pause and head into a new direction. Reversals that occur at market tops are known as distribution patterns. This means that the asset is being more actively sold than bought, indicating a shift in sentiment towards the asset. This would also mean that traders are losing confidence in the asset while selling pressures increase. In turn, reversals that occur at market bottoms are known as accumulation patterns. Head and shoulders, double tops or bottoms, and triangles are the most common reversal patterns. To read stock chart patterns, traders need to first identify trends and search for patterns that determine the direction of the trend. Then, set entry and exit points based on these patterns accordingly. The triangle patterns are formed by drawing trend lines along a price range, which becomes narrower over time due to converging trend lines. These patterns can be either bullish or bearish with three potential triangle variations: ascending, descending, and symmetrical triangles. An ascending triangle is a bullish chart pattern. The upper trend line of an ascending triangle must be horizontal, indicating that the price is struggling to break above its current level. The lower trend line then rises diagonally, indicating that the market is gradually becoming more aggressive to purchase at higher prices. Descending triangles are an inverted version of an ascending triangle. The triangle pattern is a bearish continuation pattern where the lower trend line will be visibly horizontal, connecting near the same lows. Symmetrical triangles are a pattern that occurs in both uptrends and downtrends. The patterns consist of an upper trend line connecting the highs and a lower trend line connecting the lows. As the price approaches the apex of the triangles, traders look for a breakout in either direction as a sign of a new trend. These patterns usually signify a period of consolidation or indecision in the market and often indicate that buyers and sellers are presumably equal in strength. For instance, consider XAU-USD, which has been trading in a range of 1920.00 to 2016.20. During this period, gold prices form a symmetrical triangle pattern on the chart, indicating the market's indecision about the direction of the price action. When gold prices break out above the upper trend line, it could result in a bullish signal, indicating that a potential upward trend is inbound. However, traders would usually wait for a retest of the breakout level to confirm the validity of the breakout. This occurs when the price returns to the breakout level, which will now act as a support level, and bounce off it, indicating that the level has held, and a bullish trend may continue. Therefore, traders usually use other technical indicators and fundamental analysis combined with retests to confirm the breakouts and avoid false signals. The head and shoulders pattern are a bearish reversal pattern that appears as a baseline with three peaks, with the outer two peaks being close in height and the middle being the highest. After a long-term bullish trend, the price rises to a peak, the left shoulder, and then falls back to form a trough. The price will rise again to form a second high that is significantly higher than the initial peak, the head, before falling once more. The price will then rise for the third time, the right shoulder, lower than the first peak before falling yet again. A neckline is then drawn, connecting the low points of the two troughs. If the price of the asset breaks below the neckline after the formation of the right shoulder, the pattern is considered to have formed and it indicates that the price is most likely to lower further. On the other hand, an inverse head and shoulders pattern is a bullish reversal pattern and is a mirror image of that of a regular head and shoulders pattern. This usually forms after a downtrend. Take the S&P 500 index in this instance, which has been in a downtrend in the past several months, forming a series of lower highs and lower lows. During this period, the index's price forms an inverse head and shoulders pattern. When the asset price breaks the neckline at 37.50 and retests this level successfully, it could result in a bullish signal to indicate a potential upward trend. Similarly to the other patterns, traders usually use other technical indicators and fundamental analysis to confirm these breakouts to avoid false signals. Everything that we've learned today provides an in-depth understanding of stock chart patterns. By now, you should have a better understanding of the various patterns and how to interpret them, but we remain curious to which chart pattern seems the strongest, in your opinion? Share your thoughts in the comments below.